Chris, can you explain price against earnings ratio with an example, if possible? Yeah, absolutely. Absolutely. Sure. So what we'll do is we'll use Coca-Cola as an example. And let me go to see what Coca-Cola's valuation is at right now. So let's go together to Yahoo Finance, okay? And we'll type in the ticker for Coke, which is KO. And we could have used the trading blotter as well, which I have open. Okay, so Coca-Cola has a price earnings ratio of 30 times. Okay, and I'll explain what this means. Whenever you see a fraction, I don't want you to ever think of anything except for the number 1 on the denominator. And here's why. So price to earnings means price divided by earnings. And so if Coca-Cola has a price earnings ratio of 30 times, that means for every $1 on the denominator, earnings, for every $1 in earnings, investors are willing to pay $30 for that $1 in earnings. Okay. And usually a company that's growing very, very fast has a high PE because people are willing to pay more than that $1 in earnings. And so a company not growing very fast usually has a low PE, maybe, 7 or 8 times earnings, because people don't want to pay much for a company that's not growing. So in that case, a company not growing at all, if you pay 8 times earnings, it would be for every $1 in earnings on the denominator, investors are paying 8 times. Now, for a company that's growing very, very fast, there's a lot of tech companies out there growing really quickly. A price earnings ratio of well over 100 times might seem expensive, but it's not always, and here's why. The problem with Wall Street and with a lot of investors in general is their short-term focus to the extent that they look at price earnings ratios based on earnings this year or next year. You can't do it that way, especially with growth stocks. You got to be long-term focused. And so I remember years ago, people would tell me, Chris, you're crazy to own LinkedIn, ticker LNKD, when it was public, or Amazon, ticker AMZN. You're crazy to own these stocks, Chris, because they're trading at well over 100 times earnings. And I would say, no, they're trading at 3 times earnings. And they would say, WTF, why the face? Why are you saying that? 3 times earnings, it's 100 times earnings. No. Because I value my companies based on my forecast of financial statements and based on what I think earnings will be in 10 years. And so instead of valuing companies on a PE based on this year's numbers or next year's, I look at earnings in 10 years. And if it's a company I love, then in my forecast, my earnings are massive in 10 years. And so I value the company off of a price earnings ratio based on earnings in 10 years. So in that case with LinkedIn or with Amazon, when I invested years ago, people were saying, Chris, you're crazy. It's a widowmaker to invest in that. I would value them based on my earnings estimates, 10 years out. And then my target price would usually be based on a higher price earnings ratio. So if a stock is trading at 3 times my earnings estimates in, 10 years, and I think it should be trading at 20 times my earnings estimates in 10 years, then I see upside from a PE multiple of 3 times to 20 times for my target price.